Hi guys, my name is Alexander Sheffalo. I'm a risk and ops analyst here at Eightcap, and today I'm going to give my bi-monthly gold report and discuss its price action. First, I'm going to cover some of the current fundamental factors you must consider when trading gold, and afterwards I'm going to get into the technicals and discuss gold's current price trends during, as of now, its 1960 through 1970 price range in the late afternoon European session on Thursday, March 30th, 2023. Okay, so the major factors to consider this week for gold are the following. Powell privately believes in one more rate hike. So Representative Kevin Hearn reported to Bloomberg that Jerome Powell admitted he still sees one more rate hike when he was in a private meeting with U.S. lawmakers on how much further the central bank will raise interest rates this year. Despite the revelation, the federal funds futures curve, a market-based gauge of what the Fed will do at future meetings, has only increased the chances of a rate hike in May to 45% from 43% previously. The same gauge sees odds favoring the Fed not hiking rates at all, with a 55% probability of such an outcome at the May FOMC meeting. Higher rates are negative for gold as they increase the opportunity cost of holding gold and vice versa, staying in cash or cash alternatives. Another fundamental is the current macro fundamentals undermine the US dollar outlook and support gold price. The US dollar is suffering from a negative outlook compared to its main counterparts, especially the euro. This could result in losses from the US dollar index, which tracks the value of the currency against a weighted basket of counterparts. Such a deadline would provide a bullish catalyst for XAU-USD. In the case of the euro, the US dollar may decline due to a possible closing off of the interest rate differentials between the currencies, which hitherto has favored the US dollar. Currencies with higher rates gain an advantage via the effect of the carry trade, in which investors profit by borrowing currencies in a low interest rate jurisdiction and using the money to borrow a currency yielding a higher rate of return. The gap is likely to close because the Federal Reserve is widely seen as reaching the end of its hiking cycle, while the European Central Bank is still viewed as beginning its cycle. The Fed is also seen as more limited in how much higher it can raise rates compared to the ECB due to effects of higher interest rates have on the two regions' banking system. Obviously, at the moment, the U.S. Banking system is a little bit more exposed than the Europeans. Although I will say Credit Suisse was also a big issue for European banking as well, but probably not as big as SVB and some of the sort of regional banks that were showing some issues in the last 3 weeks. Also, today, the U.S. jobless claims report for the week ending March 24th showed an unexpected rise to 198K on Thursday, well above the 196K forecast and the 191K previous. The data suggests the labor market may be weakening and could encourage the Fed to pause and not hike rates at their next meeting. In fact, after the release of the data, the probabilities of the rate hike as measured by the federal funds futures curve rose a percentage point to 56%, with chances of a 25 basis point hike falling slightly to 44%. This, in effect, has pushed gold slightly up on the day. Heading into next week, traders should keep in mind the following events and data releases. On Wednesday, the U.S. Bureau of Economic Analysis will release the gross domestic product growth for the fourth quarter. Since this data will be a revision, it is unlikely to garner much attention and effect. But earlier Friday, the MBS manufacturing PMI and non-manufacturing PMI data from China will be closely watched by market participants following February's decisive rebound. Another increased headline PMIs could help gold gather bullish momentum, pointing to improving demand outlook in China, the world's biggest gold consumer. Finally, The Personal Consumption Expenditure, PCE, price index data will be featured in the US economic docket ahead of the weekend. The annual core PCE price index, the Fed's preferred gauge of inflation, is forecast to edge lower to 4.4% in February from 4.7% in January. Now let's look at some of the chart information here and discuss this daily chart. So looking at the chart, obviously you can see that XAU USD or gold is in an uptrend from the medium-term perspective. The price of the precious metal continues to make higher highs and lower lows on the daily chart shown here. Sort of the big and fast rally here obviously was caused in uncertainty in the U.S. market, Silicon Valley Bank collapsing, the regional banks being put under pressure, and the overall slight banking crisis. This caused real yields to fall, and gold has entered a consolidation near its previous high, going back as far as last summer. We can also kind of see that the price is diverging with the moving average, convergence and divergence. So the MACD for people into technicals, which is generally a sign of a loss of momentum, and we can generally see a pullback afterwards. The market started to consolidate as the data after the banking crisis has not confirmed weakness in the economy yet. On the contrary, the economic reports have been stronger than expected. It's likely that we will see major pullback in the case the data keeps beating expectations. Now moving forward, kind of looking at this 4-hour chart, a little bit of a shorter term here. So I would generally say that looking ahead for traders going long, a break above the 2009 mark, I would generally say. So the 2009 March top would provide a confirmation of further upside. The next target for gold would lie around 2070. And this would be going as far back as March 22 highs. That would really push the bulls. And for traders going short, let's kind of take another closer look here. The key 1934 March 22 swing low must hold for gold bulls to retain the advantage over the bears, yet a break and close on the daily basis below that level would introduce doubt into the overall bullish assessment of the trend. Such a move would see a sharp decline support at 1990, supplied by the 50-day simple moving average. So if it kind of busts through this, the thing to look out if I was a bear would be this 1990 region, but at the moment it's consolidating, but it seems to be looking more on this trend. So it's really anyone's bet here. But generally, overall, I would say the gold price is bullish and a bullish trend despite some sort of lack of direction in the past week. And we'll have to see where this trend ends up to make a further analysis. So that concludes our video today. Thank you for tuning in, and I'm looking forward to updating you again in 2 weeks' time.